Hi, folks. Happy Friday. Sorry about the delay in getting started. So we actually had a potluck lunch that was being coordinated by the graduate council, and I'm the head of the graduate council. So when you're head of anything, then they basically assume that you'll take responsibility for the details. And so, yeah, they got it scheduled right during my class. My AIS class was like 11:30 to 1:30, and I was in there cleaning up. It's still not fully cleaned up. I'm gonna have to go there after class to make sure it picked up. That's what I earned my PhD for, is to make sure potluck lunches were cleaned up after. That was my PhD. Accounting or PhD in accounting and potluck lunches, apparently. All right. So today we're going to start out chapter 3. We're going to do some introductory stuff, and then we're going to go over your homework. So generally speaking, our homework will not be as short as this one, but this is a kind of a good introduction about what we're going to need to do. So let's just go ahead and talk a little bit about some planning concerns with respect to the beginning of the audit. So the very first thing we need to consider is that auditing is a business, and we need to be very, very cautious and careful about who we select. It sounds great to say we're going to accept any client, but keep in mind that this is a highly litigious industry. More so, it was even more so litigious 20, 30 years ago. Basically, auditors could be sued for any problems that their clients had. That's still true to some degree, although it's not as bad as it used to be. So we need to be very careful that when we accept a client, that we have a lot of assurance that we're going to be able to do our job and do it properly. So the first thing we need to understand is, what are some considerations in accepting a new client, or if we can currently are working on an audit client, whether we want to continue working on that client, continue to do the work for that client. And this is going to be one of the concerns that we're going to talk about next Wednesday. You all have a discussion. Remember the discussions. They're not for a grade, but I do expect you to complete those. We're going to be answering the question in class: are we going to continue working for our current client? And you're going to answer some questions based on what some materials that I provided to you, as well as some concerns that we're going to think about here. So what are some things that we need to concern ourselves with? First of all, for a brand new client, we have never audited them before. Possibly they have never been audited before. There's two possibilities. They have been audited. If they haven't, then we're going to reach out to their prospective or predecessor auditor. So before accepting a new client, an accounting firm must first determine that it is capable of performing the engagement. And this is probably the number one priority in concerning and accepting a new client. If we think about the size of the client and the capability of our firm, that is going to be, there needs to be some parallel there. And it works both ways. For example, we probably would not bring in KPMG to audit Greek Corneros down the street, okay? And if they did, it would be like one associate, and then they would say, why are you charging us so much for one associate to do the audit work? And it wouldn't work. It wouldn't work. That's why we probably have a Kirksville firm that would do something like that. On the contrary, a Kirksville firm probably would not be auditing Amazon or Walmart. That's going to be one of the big four firms. So there does need to be some alignment and capabilities there, which is why we have accounting firms of all different shapes and sizes. And then we have compliance with legal and relevant ethical requirements. Okay, the legal requirements are generally going to be guidelines, whatever's in that industry. We also need to consider the ethical requirements, particularly with respect to our profession. As I said, we're going to talk about the Code of Professional Conduct in depth later on this semester. And a lot of that concern has to do with auditor independence, which is something we have to evaluate as we move forward with this process. And we also need to consider the integrity of the client. Now, this probably goes without saying, but if we think the client is doing something wrong, we may want to question as to whether or not we want to accept a client. Now, I want to be very, very clear about what I'm saying here. I am not saying that if you identify any problems with a client, that the answer is no. I'm saying that we need to be we need to understand what the situation is, and we need to evaluate it holistically. We need to evaluate every single factor within the context of the client. And so the reason why is because when you evaluate this on Wednesday, I don't want you to make a snap judgment and say, well, there's one thing wrong, the answer is no, okay? Or if you identify like 50 different things that are wrong, say, you know what? In the grand scheme of things, that's really not all that much, okay? The universe is a big place, okay? We do need to evaluate it within the context of the size of the client and our capabilities as a firm. So those are going to be our considerations. Moving forward, when the respective client has been previously audited, the successor auditor, that's us, we're the external auditor, we're the successor auditor, the current period auditor, makes inquiries of the predecessor auditor, who is somebody who is here before us, all right? Before accepting the engagement. What do we want to know? Management integrity. This is part of that, considering the integrity of the client. any disagreements with management, the nature of the disagreements, okay? Particularly if they were contentious disagreements. If management said, we don't agree and we will fight you at every point in the way, contentious disagreements with management are certainly problematic with respect to auditing. We'll see that here just more in just a second. And then we also need to make sure we communicate with corporate governance. What did I say corporate governance was? We talked about this on Wednesday. Who are the parties in corporate governance? Board of directors and who else? The audit committee, okay? Board of directors and the audit committee, particularly with those communications to the audit committee. One thing we want to know is the reason for the change in the auditor. Now, I realize this sounds bad to say, all right, we're changing the auditor because they didn't give us the opinion we want and we're mad, all right? If that's what the client tells you, you probably want to run away, all right? That's probably not a good reason. But is there a logical reason why they might want to change the auditor? The answer is yes. It could just be something as simple as they've outgrown the client, or sorry, the client's outgrown them. So think about a company like Amazon. All right. What was Amazon 20 years ago? Were they still this massive multinational powerhouse that sold everything under the sun? No, they were a textbook seller. They were a textbook retailer online, one of the first in that market. I remember I bought my textbooks when I was going to OU from Amazon. And so they've grown and expanded in their offerings. Over time, they probably have changed their auditors many, many times because they become much larger over time. If that happens, there's a logical reason why you might want to change the auditor. And then we also want to be aware of any related parties and unusual transactions. Unusual transactions is pretty self-explanatory. I want to mark that related parties thing because that related parties concern is something we're going to have to talk about at length here in just a second and understand what is the nature of related parties and what is our responsibility as auditors. All right, so this is kind of what we're going to be looking at with respect to client acceptance. All right, and a lot of the information that we gained from the predecessor auditor will be helpful. Ultimately speaking, what we would love to do is we would love to have the predecessor auditor allow us to use their audit reports that they've issued in previous periods. That would make our job much easier. All right. That's not a requirement that they do so, but we would love to have that information so we could actually have that moving forward. Ultimately, though, any information we get from the predecessor auditor about a current client is going to help us with our decision making, going to help us with our acceptance. Let's talk moving forward about what if we're the auditor and we want to move on to the next year with the client. Are we going to accept the client moving forward? This is called client continuance. For the most part, I would say 99 times out of 100, we're going to say yes. Because if we accepted the audit in the first place, or if accepted the client in the first place, the client, yeah. If we accepted the audit in the first place, as long as the client or the audit went somewhat smoothly and was reasonable, we're going to say we can continue performing this engagement. But what are we going to have to do with respect to client acceptance or client continuance? Well, first of all, we're going to evaluate client retention periodically. This will occur near the end of our audit or near the audit completion, or if there's been a significant event is really important. So say, for example, halfway through the year before the audit's about to start, they merge with another company. This would probably be something where you'd say, all right, do we have the personnel to now manage this much larger client? If the answer is no, we may want to not continue on as the auditor for that client or suggest they get a new auditor. Or if they dispose of a client segment, if they have some significant event that changes the structure or the nature of the organization. What are the primary reasons that we might say we are not going to continue on with the client? Now, there could be some reasons like the ones we've talked about before. If we say we're not going to continue on because the client's just become way too large, that's a valid reason. They would probably need a new auditor in that situation. But what are some more key reasons? Well, one of the biggest ones is going to be if there are conflicts over accounting and auditing issues. So remember I talked about contentious management earlier? What if every time we go to the management and say, yeah, your allowance for bad debt expense is not nearly high enough to meet for what your bad debt expense actually is. You need to raise that percentage. And they say, we are never going to do that. It doesn't matter how much you threaten us, okay? If they're unwilling to actually agree to any of the things that you suggest, this is probably not an engagement that you want to continue on with, because the whole point of the audit is to actually identify any areas of problems and correct those. So if they're not willing to do that, then yeah, that's probably not an engagement we want to continue on. The other one is going to be disputes over fees. All right. And this sounds like a minimal one. This sounds like so petty. It's like, well, the auditor doesn't get paid what they want, so they're going to leave the audit. It sounds like they're throwing a tantrum. Let me ask you this, okay? You guys are spend 4 to 5 years in college to get your accounting degree. You're going to go out and go get a job, and somebody's really impressed with your work and they want to hire you and they offer you $10,000 a year. I mean, it's money, right? You're getting paid, right? Isn't that reasonable? So yeah, we just accept that. Everybody on board with that? I'm going to assume that everybody in this room is going to have a higher threshold for their salary than just $10,000 a year. Okay. And so every single person in this room is worth more than $10,000. Actually, one person is not, but he's teaching the class. Okay. So he's actually got some job security already. So everybody's room's worth that. So that's the same truth for fees, is that if we believe that we're worth more, that it cost us, or that our work is going to cost us and incur certain fees for us, we need to have accommodation to actually reach that amount of salary, to reach those fees. Okay. And that's something that came up quite a bit. If you talk about going back to 2008, does everybody remember? Well, you may not remember it, but do you know that 2008 was a global financial crisis? At the time, a lot of companies did not have discretionary income, and so they were scaling back their audit fees, which is certainly problematic for the auditors, because the auditors are going to justify their workload based on the amount of fees that they're able to charge. If we can't do their job, then we're helping ourselves to more litigation. So there were a lot of times auditors say, we can't do the work for that little amount of money. That's just not possible. A lot of auditors end up leaving clients at that time period. It was a very interesting time to be an accountant. I know, because I was. All right. So yeah, that's something to concern yourselves with as well. All right, but let's assume we're moving forward. We're going to go into the engagement. And the reason for that is pretty straightforward, because if we don't move on to the engagement, I have nothing more to teach you in this course. Okay. So we actually have to have an engagement to be able to do an audit. So what are we going to do if we move on to the engagement? Well, we've got some preliminary engagement activities. And first of all, determine the engagement team requirements. Okay. This is not just the number of people, but the composition of the team. How many associates, how many seniors, how many managers, how many partners. Also, if we're talking about a particular client concerns, we need to understand what is the nature of the entity. Will it require specialists? Will we have to have personnel who are specialized in that particular industry? How many people in this room understand oil and natural gas accounting really, really well? Actually, I shouldn't raise my hand either. Okay. I've done oil and natural gas audits. I still don't understand it. All right. It is a nightmare fiasco that involves a whole lot of accruals and a whole lot of reversals, and it doesn't make any sense to me even 20 years later after I've done them. So we probably need somebody who has a little bit more knowledge than I do to be able to supervise that type of engagement. That's true for all types of industries. Also, ensure compliance with legal and ethical independence requirements. Okay, so there are some really nitpicky concerns that can kind of come up here. So we talk about independence. So let's talk about this. If I am an auditor and I am trying to determine if I'm going to continue on with a client and they have unpaid audit fees to me, can I continue on with that client? Can I continue auditing that client? What's our default answer for every accounting question, by the way? It depends. Yes, it depends. What does it depend on? The answer is, if the fees are over a year old, we cannot go on to that engagement. Does anybody know the reason why? So remember back in 303, you learned about payables, and what happens to a payable if it's over a year old? Becomes a long-term payable. Long-term payables have imputed interest associated with them, right? When you have imputed interest associated with the debt, you have ownership. So you're auditing something that you have an ownership interest in, which is a violation of independence. That's just one of many silly little rules that we have to be very aware of. If we got fees that are over a year due, we can't be an auditor. Okay, very, very silly rule, but a really important one to note. Also, we want to establish an understanding of the entity. That involves several different things. The engagement letter, using the work of the internal audit function, and the role of the audit committee. So let's talk about each of those in turn. So when I talk about the engagement letter, obviously I'm talking about this. Isn't that great? Okay, happy, congratulations. I'm not going to single anybody out in this room. Anyway, yeah, it's not the engagement I'm talking about. Sorry, guys. Engagement letter I'm talking about is a contract between management and the auditor to determine what is going to be the work that's going to be performed over the course of the engagement. Now, there's some things that we need to note. First of all, the definition that the book says, it's on page 71. Letter serves as a contract outlining the responsibilities of both parties. There is a lot to this particular letter. There is a lot that goes into this. I want you to remember three things. And remember where I talked about how there were things that are going to be in the lectures that are not in the notes. Here come three items that you should take notes on, because I will absolutely test on them, but they're not in the slides. Okay. Three sections that are always part of every audit engagement letter. First of all, the objective of the audit. The objective of the audit. What it is that we're trying to accomplish through this engagement. Next, we need to define what is management's responsibilities. And generally speaking, we've already talked about that, but these are outlined in the engagement letter. Remember, management's responsibilities are going to be the fair presentation and preparation of the financial statements and the design, implementation, and maintenance of internal controls. But why do we specify management's responsibilities? Because the third section is the auditor's responsibilities. The auditor's responsibilities are primarily going to be performing tests and analysis over the financial statements and internal controls to make sure the financial statements are free from material misstatements and the internal controls are operating effectively. So just a reiteration, objectives of the audit, manager's responsibility, and auditor's responsibility. Please make sure you know those three, but most importantly, make sure you have a basic understanding of what they represent. If I go into an exam and say, auditor's responsibility is for the fair presentation of the financial statements, is that a correct statement? No, that's management's responsibility, okay? So make sure you have at least a general understanding of whose responsibility those are. All right. What about the internal audit function? So this is an interesting statement. Prior to 2007, auditors could not actually employ the work of the internal audit function. This is actually between 2002 and 2007, but before 2002 is a little bit different. But in that 5-year period, the Sarbanes-Oxley Act said that auditors had to get all assurance that they gained over an engagement themselves. They could not use the work. So what is the internal auditor? We define that on Wednesday. These are people who work for the client that do work on an ongoing basis to make sure that controls are operating effectively, reporting systems are in place, the accounting information systems are up to date, all kinds of additional tasks. Their work is far more varied than what we would be doing as external auditors. But the good news is they work for the client. So they probably have a better understanding of the operations, the controls, the financial reporting systems, all these things that are in place at the client. And the good news is the PCAOB said in 2007, hey, you can rely on the work of the internal audit function to get some assurance. So in other words, you can actually have a starting point. You can use their work and say, all right, here's some things we already know. What else do we need to know? It's like basically buying a cheat guide, okay? A little cheat guide where you say, all right, here's the information on the client that we wouldn't have otherwise. We don't have to go through the work of identifying this information. We've already got it. The internal audit function provided to us. That is contingent upon 3 things, though. Contingent upon 3 things. Before we can actually use the work of internal audit function, we must evaluate the extent to which the IIF's organizational status and relevant procedures support the objectivity of the internal auditors. So the internal auditors have to be able to do their job free from management interference. If management actually has oversight over those and they make the internal auditors do things that they don't want to do, they're not objective in their role. That would be as an external auditor, we'd say, thank you for this information, but we can't rely on you. Your information, your insight is not objective. Related to that, we want to make sure that they have competence. So the level of competence of the IF. If they're working really, really hard, but don't know what they were doing, then probably don't want to rely on their work at all. And then the third one's a little bit funky. We want to make sure that they apply a systematic and disciplined approach, which includes quality control. So not only do we want to make sure they're objective and competent, but what they do makes sense, that somebody can actually follow the procedures and understand what it is they're trying to accomplish. So to break it down a little bit more, here are the 3 boxes you should know for this. Objectivity, competence, systematic, and disciplined approach. Now, I do want to make a quick note of this because this may come up in the homework. 2 of these are required by the Auditing Standards Board. All 3 of these are required by the PCAOB. For our purposes in this class, we're going to assume all 3 are required, but you have a homework question which is going to identify 2 of these. You don't need to necessarily identify, say, this is wrong, it's 3, okay? If you identify that it should be 3, good for you, okay? But depending on whether we're talking about a public company audit or a private company audit, then we'll only have to consider 1 or 2 or 2 or 3 of these. But for our purposes, for the most part, I'm going to assume that you have to know all 3, but in the homework, it may come up. All right, last one we're going to talk about. We're going to talk about the audit committee. So the audit committee is a subcommittee of the board of directors. Now, interestingly to note, we're going to be talking about PCAOB rules because under ASB rules for private company audit or private companies, there are no requirements over who can be on the audit committee. Okay, I'm going to repeat that. For private companies, there are no requirements over who can be on the audit committee. So let's talk about public companies because that's far more interesting. What do you think? It's like, that was simple, Dr. Barnes. Just move on. Just move on. No, we're going to talk about audit committees for PCAOB rules. For publicly traded companies, all right, what does this mean? SOX 301, Section 301, details specific requirement and responsibilities for audit committee members of publicly traded companies. So the big one to note is they must be outside independent board members. So that obviously they need to be members of the board, But what does it mean to be outside and independent? It means that you cannot have management on the audit committee. And that probably makes sense because we don't want to have people on the audit committee who are trying to test their work. So managers can't be audit committee members. That's for publicly traded companies, by the way. Again, remember, these rules don't hold for private companies. We're just talking about public companies. And then SOX 407 requires that at least one member of the audit committee has to be a financial expert. Now, I want you to note, if you're curious about what financial expert means, I did a favor to all of you because I know as accountants, you all really want your own copy of the Sarbanes-Oxley Act. So I put a PDF copy on Brightspace. You can download it. You can put it on your personal device. You can actually treasure it. If somebody's having a conversation with you at the pub this weekend and you're just kind of like saying, you know, I was worried about section 404 of the Sarbanes-Oxley Act, you can pull it up and you'll have that knowledge just right at your fingertips, okay? So that's my gift to you all right? This copy of the Sarbanes-Oxley Act. And if you don't have that copy, you should get that copy because you really need one as accountants. That being said, what does financial expert mean if you don't want to look it up, if you're just not really up to it right now? It means that you have to have experience in the application of audit procedures in an audit engagement. And this is going to be from the client side. So usually this requires somebody to be a CFO or controller position for at least a year. So by that definition, nobody in this room would actually meet financial expert. I would come the closest, but I've never been a controller of a CFO, so I can't actually qualify for audit committee for financial expertise. But the good news is only one person has to meet that requirement on audit committee, not the entire audit committee. All right. So we got a strategy. Strategy helps the auditor determine what resources are needed in the engagement. Then we move down to the plan. This is more detailed in the strategy. Considers how they conduct the engagement in an effective and efficient manner. What is going to be in the strategy and the plan? So let's talk about some more considerations. So we're going to talk about a little bit of these in more detail. So first of all, we want to assess business risks. What we're going to identify is business risks are strong indicators of risks that are present in the organization. Have we talked about risks in a previous class? I hope everybody remembers that. It says, yeah, Dr. Barnes, those are, you have to have controls, responses to risk. That's your favorite thing to talk about in AIS. I got sick of it. Yeah, that's fair, okay? Because I do talk about it a lot. We're going to talk about risk assessment and the role it's played. That's actually next chapter. We need to evaluate risks that are present in the organization. And we're going to try to classify those to do a better analysis of what our responsibility as auditors. Next, we're going to establish materiality. One of my favorite things to talk about, it is a quantitative measure that is heavily subjective in nature. Now, what does that mean? It means that I'm going to make you do some calculations, and those calculations could be correct or wrong. It's going to seem like it's actual accounting, and then you're going to say, I don't know. Remember I was saying that the very first thing we're going to do for the Earthware assignment, you're going to say, like, I have no idea if this is right or not. Every single student in this course has ever said that statement in their head at one point, okay? This is going to be a very subjective exercise to understand how do we assign materiality. And I will say there's no right answer. It's not a one-size-fits-all procedure. It's going to be different from person to person. It requires very high levels of professional judgment. We want to consider multi-locations. For really large organizations, they're going to be domiciled in multiple parts of the world. How do we conduct audits if we need to go to different parts of the country or different parts of the world? Assess the need for specialists. I talked about oil and gas. That's an example that we might want to consider as well. Consider violations of laws and regulations. So illegal acts. We're going to talk about this when we get to risk assessment in chapter 4, but I do want to preface this by saying an auditor has a responsibility to plan the audit and provide reasonable assurance detecting illegal acts that have a direct and material effect on the financial statement. In other words, we don't have to detect every single fraud or every single illegal act that the client is committing, but if it has a direct effect on the financial statements and a material effect, both of those things together, our audit procedures need to be sufficient to identify those. That is our responsibility for fraud. And that's actually been in place now for about 25 years, that rule has been in place. We'll talk about identifying related parties here in just a second. We also want to consider additional value-added services. This is kind of a dicey one because in 2002, the Sarbanes-Oxley Act basically said most audit services or most non-audit services we'd like to provide, we can't. And the reason why has to do with independence issues. If we're doing tax services or accounting information system preparation, then we're not independent from the client, or we're effectively auditing our own work. So that's why auditors generally can't do more work than just the audit. But some situations we can. There are a few niche areas that we can do that. Okay. And there's an argument by a lot of partners in accounting firms that this is a good thing. that we can do these things because we've got a lot of knowledge about the client that's just not going anywhere, that we'd not be able to utilize for any other purpose than the audit. So if we could use it in other capacities, we could help them make value-added decisions. We also want to document the overall audit strategy, audit plan, and prepare the audit program. So we're going to talk about documentation in chapter 5, but basically we're going to set the stage. We're going to say, here's our goal. Here's what we're planning on doing. Here's how we're going to accomplish it. And then we'll document everything moving on past that. All right. What is a related party? What do you guys think? Related party. So obviously, if we talk about familial blood relationships, that could be blood related party, but is it possible to be a related party even if you're not a blood relationship? Certainly that's the case. So one of the things that characterize, one of the statements that characterize related party transactions is that related party transactions may not be at arm's length. And I will say that for the most part, if you look in accounting vernacular, they say related party transactions are not at arm's length. All right. Now I say may for the reason that I'm going to I'll explain here in just a second, but for the purpose of this, let's think about what arm's length means. Okay. If you engage in a transaction with somebody who's not a related party, you have no other existing business relationship with. So you say, I'm going to do a contract, I'm going to do a job, and they say, that sounds good to me. I'll pay you this amount of money for doing this work. And say, all right, let's shake hands on it. Okay. When you shake hands, you're at arm's length. Okay. You're at arm's length. That's what the arm's length transaction is. So now think about somebody related party, like a parent. Okay. One of your parents says, I'd like you to do this work for me. He says, oh, that's not a big deal. I can do that for free. He says, oh, thank you so much. That's really nice. Are you going to shake hands? Somebody might, and that's weird. Okay. Probably just going to give him a hug. So, yeah, you're important to me. I want to make sure that you're happy. Yeah. That's closer than arm's length transaction. That means the transaction is not at arm's length. Related parties are characterized by this concept. That doesn't mean every single transaction that's a related party transaction, they have to hug, but you get the idea. You get the idea. So what does the auditors understand or responsibility? So the most important ones are going to be to retain an understanding of the relationships and transactions. So we want to know this related party transaction. Is this consistent with other transactions that are of this nature? Ultimately, we don't have the responsibility to issue an opinion based on this, but we do have the ability to issue opinion if the second point is not met. We have to ensure that transactions have been properly evaluated and disclosed. Generally accepted accounting principle rules require that companies disclose all related party transactions within their financial statements. So we as auditors have to enforce that. If we identify a related party transaction and we determine that it has not been properly evaluated or disclosed, then we're going to say, hey, this needs to be done. Otherwise, we can't issue a clean opinion. So related party transactions is really important. This will not be the last time, by the way, that we see related party transactions come up. They will pop up throughout this course. This is just our introduction to understand what is the nature of a related party transaction. All right. Just as a preamble for what we're going to be doing moving forward, we've got risk assessment procedures coming up in a couple weeks when we start after that. So that's going to be week 3, we start risk assessment procedures. Then we're going to be doing substantive procedures the week after that. We will jump back and do test of controls after that. And then we're also going to talk about some other things. I do want to throw this out because this may come up. It is important to note that while test of controls and substantive procedures should look substantially different in the way that they're conducted, there are possibilities that we conduct similar procedures simultaneously that are both test of controls and substantive procedures. And these are called dual purpose tests. Now, these don't come up frequently simply because of the nature of testing and what we have to determine over our process of testing. As we're going to find out in the next chapter, chapter 4, generally speaking, we have to have an understanding, a pretty detailed understanding of controls before we can move on to understanding of what we need to do for substantive testing. It is a sequential process, so it's very difficult to do testing in one area and another area simultaneously since it is a sequential process. But it does come up there's a possibility we'll see it in this course. And if it does come up, you should think about this as a dual purpose test. And this is just basically being efficient. This is not saying that they're doing the same task at the same point in time. They're not doing the same thing and applying it to 2 different areas. This is more along the lines of they're doing 2 tests that are related. So an example of this would be like going to the pharmacist and they're getting your flu shot and they say, hey, while you're here, you want to get your COVID booster? It says, yeah, I'm all about that. And then they're going to inject you like 2 more times because then there's the RPV and then there's another virus that's going around. There's like 4 of them going around that can make you sick. And you get them all in there. And then over the weekend, you can't do anything because you're asleep the entire time because you feel so sick. Okay. At least that's what happens to me, COVID. You guys, from what I understand, it's actually better for older people because they have slower reactions. Like some of those early COVID boosters, yeah, some of my students were out for like a week just because of the reactions to that. And I realize I'm rambling again. Sorry, guys. All right. So yeah, that's kind of the example that we're talking about here. So we're going to move on to the rest of chapter 3 after this, but we got some homework to talk about. So let's go ahead and do that. All right, question 113. Independent audit adds value to the communication of financial statement information because the audit does what? Does it confirm the exact accuracy of management's financial representations? Should always be careful of absolutes. As one of my colleagues once said, never use absolutes. Never. Okay. And I said never. And they said almost never. All right. So yeah, never use absolutes. Lends credibility to the financial statements. Is that a good statement? Yeah, that seems reasonable. Guarantees that the financial statement are fairly presented. Are we providing a guarantee? No, reasonable assurance is not a guarantee. Reasonable assurance is something less than a full guarantee. Assures the financial statements of fraud, any fraudulent activity have been credited. That sounds like a pretty absolute statement as well. So if we avoid the absolutes, B is the only one that sounds reasonable. So B is correct. Which of the following best describes the reason why an independent auditor is often obtained to report or retained to report on financial statements? Okay. So management fraud may exist and it's more likely to be detected by an independent auditors than internal auditors. We're going to actually talk a little bit about that in chapter 4, but the answer to this is that's not correct. Okay. We're going to find out exactly how much fraud external auditors are responsible for detecting. And I'm going to tell you, whatever percentage you think it is, it's lower than that. Okay. And unless you're like at 0%, we can't go to negatives. Sorry. Yeah, but it's probably going to be lower than what you think. Different interests may exist in the entity between preparing the financial statements and the person using the statements, and thus outside assurance and need to enhance the credibility of statements. This first statement, what does that sound like? What does that sound like a definition of? Sounds like information asymmetry to me. Yeah, okay. Did we talk about information asymmetry already? Yeah, we sure did. So information asymmetry exists and outside assurance and need to enhance the credibility of statements. Is that what we do? We mitigate information asymmetry? That is correct. So it's B. Let's go through the rest. Misstatement accounts balances may exist and all misstatements are generally corrected as a result of independent work. I wish that was correct, but keep in mind, we're going to talk about materiality in a little bit. In about a little less than a week. Materiality kind of dictates whether we actually correct items or not. If it's not material, it's not something we need to worry about. An entity might have a poorly designed internal control system. Well, that may be true, but that's not the auditor's responsibility to correct. It's just their responsibility to test it. Which of the following best describes relationships among auditing, attest, and assurance services? Those are the ovals that we looked at that I went through really quickly because I was running out of time. So auditing is a type of assurance service. Is that a correct statement? That's C. That is a correct statement. C is a correct statement. But what about attest as a type of auditing service? No, it's the other way around. Auditing is a type of attest service. Assurance is a type of attest service. That's the other way around. Attest is within the assurance oval. All right. And then B is obviously incorrect because there is overlap. There's significant overlap in these areas. Question number 18. Which of the following statements best describes how materiality is related to audit evidence in the financial statement audit? Now, this is where, being somebody who's taught auditing for 9 years, I have a really weird sense of humor compared to everybody else because I personally think A is hilarious, okay? Materiality refers to the material from which the audit evidence is developed, sounds hilarious to me, but that's because I know that's not correct, all right? So it's going to be B or C. The question is, what do we think? Is it B or C? So let's just think about the nature of materiality, all right? If I say the materiality is $1 million, and then I change my mind and I say materiality is $500,000, which is going to require more work? Materiality at $1 million or materiality at $500,000? Probably $500,000 because the errors that you're going to have to identify are going to be much smaller. Therefore, you need to do more testing to identify them. So what does that tell us? Are we going to be focused on larger materiality amounts or smaller materiality amounts? Smaller, okay? And it's going to be something we identify, we talk about in more detail in chapter 3. The smaller materiality gets, the more work we have to do. Now, just as a quick caveat, is it fair to say that if I have the ability to give you more work or less work, everybody in this classroom will be okay with less work? Okay. So keep that in mind when we talk about materiality on Wednesday, is that our goal there is going to be allocate materiality in a way that it minimizes the work for the auditor while still retaining high levels of assurance. Okay. Question 21. This is another question that I laugh at because I'm a 9-year veteran of this, okay? Which of the following statements best describes what is meant by an unqualified audit opinion? An unqualified audit opinion indicates that the auditor's opinion and the client financial statements are not fairly presented and agreed upon criteria for clean opinion. No, that's not correct. B, my favorite, an unqualified opinion indicates the auditor is not qualified to express an opinion on the client's financial statements. Well, they did say it's unqualified. It's an unqualified opinion. Yeah, so basically, unqualified means that there's an absence of qualifications. So an unqualified auditor's opinion indicates the auditor's opinion and the client financial statements are fairly presented in accordance with agreed upon criteria with no need to inclusion of qualifying phrases. That's D. That sure looks correct, but let's clarify. What is the agreed upon criteria here in the United States for publicly traded companies? Give you a hint. You learned about it back in 220 and have been using it in all your financial and accounting classes. It's also the name of a department store. Yep, GAAP, okay, although it's spelled differently for the department store, yeah. So yeah, those are going to be our agreed upon criteria for financial accounting for the most part, but it can be any of them, as we're going to see a little bit later in this course. Client has used inappropriate method of accounting for its pension liability on the balance sheet. The resulting misstatement is material, but the auditor does not consider its effect to be pervasive. The auditor is unable to convince the client to alter its accounting treatment. The rest of the financial statements presented fairly in the auditor's opinion. Which kind of audit report should the auditor issue under these circumstances? So this is an interesting question. I want to bring this up because this may come up in this course. Generally speaking, we are not going to try to talk about what is going to be the level or the degree of a particular error. Usually we'll just identify the nature of the error. Now, remember, we talked about 2 types of errors on Wednesday. We talked about departure from GAAP and scope limitation. Which one of these is this, by the way? Is this departure from GAAP or a scope limitation? It's a departure from GAAP. Yeah, they didn't follow the rules of generally accepted accounting principles, okay? It's because the pension liability doesn't need to be disclosed, okay? It's a material effect. This does clarify that it's material but not pervasive. So would this be a qualified opinion or an adverse opinion? Qualified. Adverse would have to be pervasive. That's the extreme opinion. In most situations, you won't have to worry about this. We'll actually walk through some examples of these in chapter 18. We'll have to determine what type of opinion. Chapter 18, yeah. Chapter 18, we'll have to determine what type of opinions being issued. You won't have to specify to me, well, I believe it's qualified versus adverse for these reasons. You'll just have to say it would be either qualified or adverse depending on severity. So keep in mind, we have to look for the terms material and pervasive in this situation to be able to make that distinction, but those terms usually don't come up. But in this one, qualified opinion due to departure from GAAP. All right. Some questions from chapter 2, real quick. All right. Which of the following statements best describes management's and the external auditor's respective levels of responsibility for a public company's financial statements? All right. Management and the external auditor share equal responsibility for the fairness of the entity's financial statements in accordance with GAAP. Is that true? A, is that true? No, auditor doesn't have responsibility for the financial statements. That's entirely a management responsibility. Neither management nor the internal auditor has significant responsibility for the fairness of the entity's financial statements in accordance with GAAP. For the reasons this one's wrong, this one's also wrong, but the opposite reason. Okay, management does have sole responsibility. Management has the primary responsibility to ensure the company's financial statements are prepared in accordance with the GAAP, and the auditor provides reasonable assurance the statements are free of material misstatement. What do you guys think about that statement right there? I like that one. Okay, so C is our answer. Question 21. The Public Company Accounting Oversight Board is a quasi-governmental organization that has legal authority to set auditing standards of audits for public companies. That's A. Like that one, yeah. Okay, let's go through the rest just for context. They have legal authority to set audit accounting standards for public companies. They don't have legal authority, so they basically are going to be has legal authority to set auditing standards for audits. They don't have the legal authority in accounting standards, is what I'm trying to say. That's only for auditing standards, okay? Even though the accounting is in their name, they are focused on auditing, okay? Policy to ignore public comment and input in process setting auditing standards. That's beyond our scope, but the answer is they do take in public input and standard setting. So they actually do receive information on that. And they're independent of the SEC in setting audit standards. That is not true. They are a subset of the SEC. So they're a subgroup of the SEC, and the SEC has oversight. In fact, there was a question about, this is going to be long past before our consideration, but and may have come up again, who knows. Back in 2017, 2018, President Trump had talked about eliminating the PCAOB and putting standard setting in the hands of the SEC. It did not happen. So it's going to be very interesting to see over the next few years if that question comes up again. That being said, I mean, I'm not being mocking when I say this. I do not think that the PCAOB is one of President Trump's high priorities coming in. Okay, so we probably won't see that, but it was very interesting to see that coming up in the news. especially with what is Elon Musk's committee, the Doge committee. It's like Department of Governmental Efficiency. That may be something identified that we don't need the BCOB anymore. I still can't believe they named it the Doge. That's just that just drives me crazy. All right. Try not to make political jokes, but that one's just too much. I'm sorry, guys. I'm sorry. All right. You were recently hired by the CPA firm Hansen and Hansen. Before you start working, the firm requires that you participate in first-year staff training course. The instructor asks you to prepare answers for the following questions. How is audit evidence defined? Okay, so let's go ahead and let's pair questions A and B. How is collection audit evidence related to management assertions? So we know that any information that's in the financial statements or any information related to transactions in an organization, they're going to be represented by certain assertions made by management. How do we actually evaluate those assertions as auditors? And the answer is we collect evidence. So the answer to A and partially the answer to B is going to be that we collect evidence to verify management's assertions in different areas. All right. The whole goal of evidence is to actually evaluate whether the assertions are correct. Now, remember, we had that long list of assertions we talked about on Wednesday, and I said, don't go into detail, but let's use an example. This is going to be our preliminary example before we actually get into the details of all of these. Okay. The easiest one to talk about is inventory. So we know inventory, you guys have seen inventory before. How many go shopping at Walmart or Hy-Vee? Okay. Do they have inventory there? Yes. And so let's say I'm the auditor for that Walmart down the north side of town. And they say, yeah, we've got $20 million of inventory. I have no idea what the amount of value of inventory would be at the Walmart, probably a lot more than that, but say $20 million of inventory. Okay. I can go in and I can look and say, they've got inventory here, 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 and here. Boy, it sure looks like they've got inventory. It sure looks like it exists. It's not just an empty building with nothing in there. So I can verify the value, the inventory. I can actually look at that inventory and say, I verify the existence of that inventory. I could also look at the value of certain inventory items, not necessarily what they have on the shelves for, because they're selling at a retail amount, but they probably purchased at a certain cost. I can go and look at invoices and I can say, okay, the cost of this tennis racket that they have on sale was $9.99 when they purchased it from the retailer. And they've got 20 of those tennis rackets. So that's a number I probably shouldn't have said because I don't want to calculate that number. Whatever 20 times $9.99 is, okay? That would be like $200 plus minus 20 cents, I think. Yeah, so yeah, $199, $99.80. I knew I could get there. All right, so that's what we say the valuation of the particular inventory item is. And we as auditors are going through the process of trying to find evidence that supports those assertions. If we find evidence that doesn't verify or kind of contradicts the assertions, then we're going to say a misstatement exists. That is what we're ultimately trying to concern ourselves with. So 2 key characteristics of audit evidence that an auditor must consider when evaluating the quality of the evidence. Did anybody find this? We didn't actually have this in the slides, but it is in the book. So these are going to sound very familiar because they're very closely related to accounting information. We're looking for evidence that is relevant and reliable. All right. Now, why is that the case? Why are we so concerned about the nature of audit evidence? The simple truth is that if we don't have evidence that's relevant, then it really doesn't really serve a purpose. Okay. Okay. They can say, all right, we're trying to validate the inventory valuation that's currently in the Walmart. And I say, well, according to last year, their valuation was roughly the same amount as what they're reporting. Might be ancillary relevance, but we've got more direct evidence that we can provide. Okay, I can look at the inventory itself. I can look at the invoices for the current year. Looking at the information from 1 year ago, or even more extreme, looking at information from 10 years ago is not as relevant. All right. What about reliable? What about reliability? So this is going to be something we talk about very heavily in audit evidence. We're going to find some evidence is more reliable than others. And I go talk to the manager and I say, hey, what's the valuation of the inventory? And he's going to say, oh, it's $20 million. Okay. Does that mean $20 million is correct? So I'm inquiring of management about what the valuation of inventory is, and they're giving me a response. Is it possible that response is accurate? It is possible, certainly. Okay. Is that possible? Certainly. It's also possible that manager, I could ask them that, and they're telling me something they want me to believe. So it's possible that the reliability on that particular piece of evidence is going to be low because we know management could lie. Because believe it or not, human beings have lied before. Okay. At least I think that was the Ricky Gervais movie, Invention of Lying. It's only a recent event. When I was a kid, we didn't ever lie ever. Okay. I never lied ever. So it's only in your generation that's happened. So yeah, we do know that the event can lie. So we want to make sure that we gather evidence that it's reliable. If we have low reliability evidence, we need to collect more evidence that is higher reliability, which, as we're going to talk about, certain types of evidence require corroboration, as we're going to get to later on in this course. All right, that does it for today. I'll see you all on Wednesday. Have a good long weekend.